Welcome to another great educational webinar we have here at Advanta IRA. Really happy with the two guests we're going to have join us today. I'm sure that the individuals listening to this live and probably some of you who are going to watch the recording are going to have some great questions for them. So without further ado, I want to get to the presentation and get into the meat of the topic, which is today tax saving strategies for real estate investors. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. Been with the company for a number of years now, and then done a lot of different educational events and talked to a lot of people over time. And like I said, I know today's topic is going to be especially engaging for a lot of our listeners and viewers who are real estate investors using their IRA accounts. If you have any questions regarding self-directed IRAs, or as we go through the presentation, or maybe even afterwards, jot down my phone number, jot down my email address there. You can certainly reach out to me for those individual questions as you go along. Just a quick run through our disclaimer. Advanta IRA does not provide investment or legal or tax advice, and we don't endorse any particular product. So we certainly have brought on a couple experts today to talk about tax issues in general. This is not IRA specific information today necessarily. So, but you'll be getting some good information. But again, Advanta IRA and its employees, we cannot give you the tax advice that the individuals on here today can be if you engage them separately. But we do like to provide information as much as possible from an educational perspective, and there's certainly some tax questions, legal questions we can't answer. But when it goes beyond that realm, we do put you in touch with professionals like the two guests that we have with us today. Just a quick note, if you're new to self-directed IRAs, or you're not sure who Advanta IRA is, we are a self-directed IRA administrator. We've been around for almost 20 years, and we currently have over $2.3 billion in assets under management on behalf of our over 10,000 clients that we hold. We do kind of differentiate ourselves with our competitors with the concierge level of customer service that we give, and assigning every new account to a specific account manager to help them with anything they need regarding their account. And we also try to provide a lot of educational and learning opportunities through webinars like the one that you're on today, through our video library, which consists of every webinar that we've done over the last several years. We have recorded and archived and placed on our YouTube list. So if you're listening live and heard something today, you want to go back and listen to it again, it'll be up on our YouTube page within a day or so. If you haven't heard of a self-directed IRA before, the reason why is probably because your IRA or your 401k is with a bank or a brokerage firm who is offering you limited investment products, the mutual funds, the stocks, other publicly traded assets. But the IRS regulations do allow you to invest in a much broader range of asset classes. And that's why today, real estate being one of the largest classes that we have people invest in. That's why we brought in our guest speakers today. So just know that if you have an IRA, you have an old 401k, and this self-directed idea sounds new to you, that you do have other choices beyond what your current custodian is allowing you to invest in. Each custodian can decide what it is that they're willing to hold within their IRAs and their 401k accounts that they administer. But they're allowed to do that. They're allowed to limit you, but the IRS limitations are very few. And you certainly reach out to me with questions on what that looks like. Now, as far as accounts that can be self-directed, the thing to take away from this slide really is just any type of IRA, traditional, a Roth for individuals, or the SEP or simple for small business owners can be self-directed. If you're self-employed, we offer a solo 401k, sometimes called a QRP or qualified retirement plan, education, health savings accounts, and really any former employer plan. If you have an old 401k, an old 403b, an old thrift savings plans, those accounts as well can be used to self-direct and invest in real estate, precious metals, gold, private lending, other types of assets that our clients hold within their self-directed account. The only account there's generally a restriction on using for a self-directed purpose are any current employer plans. When you're working for an employer, a lot of times they will restrict your ability to move money out of that plan while you were still employed there. So you would need to check with that employer to see what options you may have. Again, when it comes to real estate, I think the real estate assets that we hold out of the $2.3 billion in assets under management, probably 70 to 75% of those assets are real estate in nature, whether it's a rental home, commercial real estate, rental, rehab properties, multifamily syndications, raw land. There's a lot of different things you can do in real estate as long as it's not a property you're looking to use personally or maybe buy from yourself. There's really no restriction on what you can invest in when it comes to real estate in your IRA account. Again, that's why our guests have been brought on today to talk about some tax benefits of those types of investments. In general, the tax benefits of retirement accounts, really for contributions and distributions for any non-Roth IRA, which we'll talk about the Roth in just a moment, the contributions you make to the account and give you a tax deduction and thus reduce your income taxes owed the year the contribution is made. And the distributions from those non-Roth accounts end up being taxed in retirement at your tax rate at that time. So you're able to delay and defer the taxes on that income as it's coming back into your regular IRAs, but you are eventually taxed in retirement. Now, for Roth IRAs, which are tax-free entities, you won't get a tax deduction for your contribution, but ultimately that distribution comes out to you completely tax-free. So that's the big difference that a Roth IRA has over your traditionals and your SEPs and a lot of your regular 401k plans. As far as the growth in the income, with all retirement accounts, you will not pay taxes on any of the income that's generated back to the IRA as it goes back into that account. So if you have a rental property, for instance, the rental income that you receive comes back into your IRA account with no tax consequence as it goes back into that account. It is going back into your IRA, and your IRA is a separate entity from yourself. Now, since that income is tax deferred back to the account, an IRA cannot then use any tax deductions from real estate investments. So our guests today are going to probably cover a lot of the great tax benefits that you get from real estate investments. And some of those are not always available to real estate held in an IRA account. But we still thought, a lot of the people listening today are real estate investors. And so you probably hold property outside of your IRA or maybe looking to do so and think that information would be beneficial to you. That's what we try to do here at Advanta IRA is bring those guest speakers in. Now, the one exception to an IRA taking some of the tax deductions or not being able to take the tax deductions is if an IRA is subject to something called unrelated debt financed income tax from a leveraged real estate investment. The IRA can use deductions to offset that tax. And just very quickly, a UDFI tax is also referred to as UBIT or UBIT tax. If you own a piece of real estate where there is a mortgage or leverage or debt on the property, your IRA can be subject to that tax. And in that instance, your IRA can use deductions to offset that tax. So just that's very brief. Again, if you have questions on UDFI, that is definitely a question to reach out to me individually about, that we can have a personal discussion now. As I get ready to introduce our guest speakers, I would encourage you, as you have questions, some of you have already typed a number of questions into the question box. Please keep those rolling if you're listening live to the presentation. We're going to do our best to get to as many questions as possible during the presentation today, but also giving our speakers time to get through their presentation. At the end, they'll certainly share their contact information. You can reach out to them with any other questions that go unanswered. But at this time, I want to welcome in Amanda Hahn and Matt MacFarland from Keystone CPA. They are the authors of a book, Tax Strategies for the Savvy Real Estate Investor. They've been featured on a number of different podcasts and different articles and whatnot, but I'm going to let them tell you a little bit more about themselves. And again, as you have questions, please type those into the box and I'll monitor those as they come along. So Amanda, Matt, I just sent you over the controls to be able to pull up your slides. How are you all doing today?
Good, Scott. Thanks for having us again. I appreciate it.
Sure, no problem. So yeah, I'll let you, somebody just asked, where do they find the chat box? The chat box is the question box that that's where they type the questions into as we go along. So please, yep, good, just type those questions in that box. So Amanda, are you able to pull up the slides, or Matt, able to pull up your slides on your end?
Yeah, we're working on it.
Oh, can you see our slide now? We're sharing.
Oh, yeah, there we go. Yeah, perfect. Now I can see it just fine. So yep,
Awesome.
So I'll turn the presentation over to you. I know somebody had a question right off the bat just asking if you are able to take on clients based in Florida. So we are based primarily in Florida, but I'll let that be the first question and you can introduce yourselves and we'll go from there.
I will. Before I do that, I want to let you guys know we are actually expanding our office. The contractor just turned on some kind of machine. Do you guys hear that in the background, or are we okay?
It's okay. It's not distracting. Go. You're fine.
It's not distracting. Okay.
So if you see you see any hammers or things come through the wall, just let us, or hear anything come through the wall, let us know.
Maybe you can just
Will do.
let them stop there for an hour. Yeah, text Anna. Okay. Thank you so much, Scott, for having us. We're really excited to be here, and I'm glad that you shared all that great information about self-directed investing. My name's Amanda Hahn.
And I'm Matt MacFarland.
And we are CPAs by day and real estate investors by night. So like many of you, we use most or many of the same tax strategies that we'll be discussing today ourselves. We also use part of our retirement money into self-directed investing for real estate. So we're always happy to kind of share what we know, and excited to be here today to talk about some of those tax strategies. Like Scott said earlier, there are real estate related strategies for when you're investing outside of retirement account, and then there are other strategies when you're investing within retirement account. They're very different when it comes to taxes. So we'll cover that, or we'll touch on that today as well. But what was really interesting I wanted to share is that Bloomberg actually came out with an article a couple months ago that said that the 401ks plummeted an average of 20% in 2022, and retirement accounts with $1 million or more fell by over a third. So that was pretty shocking. And I think most of that result was from the stock market. What was really great is that for our clients who are investing in real estate, we didn't really see that type of drop. Right? In fact, 2022 was pretty phenomenal for those who used retirement money for real estate. So you guys are definitely at the right place, and in terms of just taking more control over your retirement money.
Yeah, and it's thank you for that introduction, Scott. A little bit about us is, Keystone CPA, we do specialize in working with real estate investors and real estate investors all over the country. To kind of answer that person's first question, I don't know if we have clients in all 50 states, but it covers a lot of states. And, I'd say probably 80, 85, 90% of our clients are invested in real estate to some extent. Some, obviously full-time real estate investors, but it runs the gamut. It could be full-time real estate investors all the way to the people that are, you're working a W-2 job, you're starting on your journey of real estate investing, starting to buy your first rental property, invest in somebody else's deal. So it does kind of run the gamut. We've got fix and flippers, syndicators, rental property investors, wholesalers, whatever you want to call it, property managers, and a lot of professional service, clients as well. So real estate is what we like. It's what we know. That's why we're kind of here to help you guys learn some stuff about tax saving strategies for real estate investors.
Yeah, so let's get started. We want to start with a pop quiz. So you guys can go ahead and put it into the chat or Q&A box. Which of the following celebrities went to prison for failing to file tax returns? Your options are Tim McGraw, Chris Tucker, Fat Joe, and Shakira.
Usually on this last option, we would throw Scott's name up there. So Scott got off scot-free today, but
scot-free.
I appreciate that. Thank you.
Yeah, just rolls off the tongue.
So yeah, definitely put what you think the answer is in the chat box, and we'll review that in just a moment here. But the reason we wanted to put this slide together is to kind of reiterate something that Scott talked about, that today's presentation is for educational purposes only. Our goal today is to
this is our disclaimer. Scott puts his legal one up. This is our disclaimer.
Yeah, ours is so this is for educational content only. The strategies discussed may or may not work for you. Even those who do work for you, or that may work for you, it may work in a different environment or capacity. So the goal is for you to get some ideas and have a better or more well-informed conversation with your own tax advisor. Meaning, if you hear something good that you think you want to implement, definitely consult with your team prior to pulling the trigger. Okay.
So now, that's get back to the fun stuff. So the answer here, for those of you wondering, the correct answer is C, Fat Joe. Now, I believe all these people did have trouble with the IRS to some extent, but I believe Fat Joe is the only one who actually went to prison for failing to file their tax returns.
And that's his real name. No, that's not his real name. That's his rapper name.
That's his stage name?
Yeah, stage name, for those of you who want to look it up.
Come up with stage names.
All right, so why are we here today? Obviously, you guys are all concerned with taxes. But what's really interesting is that the taxfoundation.org, which is a nonprofit foundation organization who has been around since I think the 1930s, and what they do is they take a bunch of tax data and they translate that to nerdy people like Matt and I on like what's going on in the tax world with respect to what do these tax proposals mean. But one of the things that was interesting that they came out in their research, again, every year has been the same, but the result was that the average American loses more money to taxes than we do on food, clothing, and housing combined.
So let that sink in for a second, right? So you're spending more money on taxes than food, clothing, and shelter combined, which are obviously three of people's biggest expenses, right? So let's look the reason behind that, obviously. So we're going to show you kind of a listing of current tax rates. So highest federal income tax rate right now is 37%. Doesn't mean that every dollar you spend is taxed at 37% if you're in the 37% bracket, because we do have graduated scales. But again, if you're in the highest bracket, you're paying, next dollar you're paying 37% on. Now I know, Scott and Amanda, you guys are in Florida. There's no Florida income taxes down there. But for those of you who are lucky to live in a highest tax state like we are here in California or New York, we can pay up to, highest tax bracket here is 13% to the state of California. So right there, somebody living in California, highest tax bracket, you're losing next dollar you make, you're spending 50 cents on the dollar at the very least on income taxes.
Yeah, for those of you who have a job or have your business that's in a corporation, you probably are paying payroll taxes up to 15%. People who are investing in real estate, when we sell rental properties, if we're not doing the right planning, we might pay capital gains taxes. Same as if you're selling stocks, right? Capital gains taxes, another 24%. And if you don't have a good estate plan, what happens when we pass away is we pay estate taxes on all of the assets at another 37%. So when you add all these up, it's not hard to believe that we lose more money to taxes every year than we do on food, clothing, and housing. And keep in mind, guys, this is before some other taxes that we all pay as homeowners, real estate investors. We all still pay property taxes. When we go shopping, we most likely are paying sales tax. So you can see all that adds up. But we wanted to do like a graphical chart or a pie chart to show you, an individual who makes about $500,000 of income after these various taxes, this is how much they have left with. About $199,000.
Super technical pie chart here. So it's, obviously this is what $500,000 looks like on the left for sure in $100 bills. But yeah, but if you think about it, right? So you're losing, in this example, we're losing 60% of the money we made to federal, state income tax, payroll taxes, net investment income tax. So that's pretty eye-opening, right? I mean, if you think about it, it's just even for CPAs, it kind of makes us pause in our tracks every time we kind of look at it too.
And the great thing about retirement accounts is, like Scott said earlier, when you make contributions to retirement accounts, many of those are set up where it reduces your current federal and state income taxes. So if I'm putting $20,000 into a retirement account, that is money I'm saving or protecting from federal and state income taxes. In addition to that, that money could be growing tax deferred between now and the time we take it out, right, at retirement. So it's really, really powerful. In fact, when we work with clients on tax planning, retirement strategies is always something we look at, regardless of age. It could be a very young investor to someone who's already retired, but that's one of the pillar strategies because it's super, super powerful. But when it comes to tax planning, I think the best place to start, when we look at how do we really protect ourselves from this craziness that we call tax.
Yeah, because there is a better way to do it, right? This doesn't have to be the situation for everybody.
Yeah.
So hey, Matt and Amanda, I had a quick question that came up while you're on that slide with the different types of taxes. I think maybe it's just so someone understands going forward. Someone asked, isn't the federal income tax the same as the payroll tax? So I know that they're different, but if you want to maybe explain the differences very quickly on that aspect. Thank you.
Yeah, so federal income tax obviously is what you pay when you file your tax returns, right? It's you're anywhere from 10 to 37%. Payroll tax is those Social Security and Medicare taxes. So if you're working for somebody else, you are paying payroll taxes. Now you are paying 7.65% of your income for, you know, most people. That if you make up to 150, that's the percentage you're paying.
If you're a small business owner, you know,
you're paying double that because you're paying for yourself and you're paying as the business owner there. So
yeah, so another 15%.
So it's payroll tax based on wages or earned income, you know, 1099 type of income.
Yeah, but great question.
But on top, yeah, on top of the income tax though, for sure.
Yeah, so these are all the different types of taxes. But you know, the starting point, and the higher your tax rate is, the more important it is, right, to protect your income from taxes. And the benefit as a real estate investor is that we can maximize our tax deductions just the same as any other business owner. So when you hear people talk about, wow, the tax code is unfair, there's so many benefits for people who own their own businesses. Well, the good news is that's also available to all of us as real estate investors too. So let's talk about some of those common expenses that we can all take advantage of when we are investing in real estate outside of our retirement account.
Yeah, and so anytime we're talking about deductions, it's, you know, we're looking for ways to, you know, what we see on our side is there's a lot of expenses that people are paying for that, you know, they're not taking advantage of or not claiming on their tax returns, not maximizing deductions as best as they can because various reasons. One, they don't know what they can deduct. Two, they don't know, you know, they forget that it's related to business, or C, they forget to just that they spent the money on that particular expense in general. But so some of those more common items that we see a lot are, you know, education expenses. You're going to conferences, you're paying subscriptions, monthly research stuff, just learning, you know, the business aspect of it. Business meals, that's another one that, you know, I think, you know, if you take a step back and think about it, when you guys go to lunch or dinner with colleagues or, you know, fellow investors or whatever, you guys are probably talking about business more times than you think you are. So when it comes to meals, you know, you're making sure you're just documenting, you know, what you talked about, capturing all those expenses, because in our experience, we see people are spending a lot of money on meals that could qualify as business deductions that people aren't claiming for those various reasons.
And for those of you who have not yet filed 2022 tax returns, 2022 meals from restaurants were actually 100% deductible versus, you know, in a normal year like 2023, the tax deduction is only 50% of business meals. But last year, or last couple years, ending with 2022, the government was trying to help out the restaurant industry since COVID. So business meals, whether it's you dine in at a restaurant or take out from a restaurant, those were 100% deductible. So make sure you take full advantage of that because that's an area we've seen quite a bit of mistake in looking at their, you know, reviewing people's tax returns.
Business travel, another area that I think doesn't get maximized or claimed enough, as much as it could. The one tip here that we want to share with everyone is when you are going to travel for business purposes, the best tip is to make sure you've set up the purpose of the business and the travel for that business purpose ahead of time. So document that, you know, you bought an airline ticket for 2 months from now to fly to wherever to look at rental properties or meet with an investor or a syndicator, whatever the case may be, is that you're documenting this ahead of time versus that makes it a tax deduction versus, hey, I happen to fly to Southern California and to go on vacation and I'm just, you know, decide to look at some rental properties. That does not make it a tax deductible trip, right? So you got to see the purpose of the trip. You know, the more days you're spending on business while you're there, the better for your deductions. But those are kind of the main tips, I think, with respect to business travel.
Yeah, and since summer's coming up, it's a very timely thing to be thinking about as you plan your upcoming trip. Home office deduction, another huge one for real estate investors. The vast majority of investors we work with do operate out of a home office rather than leasing a space to manage their rental properties. So definitely something to consider taking advantage of. Same as car, you know, most investors who have a car do also use it for real estate, whether it's driving to the rental property or driving to a local real estate meetup, driving to meet with your CPA, your attorney. Make sure you track those expenses. Currently, we have bonus depreciation, which we'll talk about in a moment as it relates to real estate. But bonus depreciation also applies to cars as well. So we have clients who bought, you know, $100,000 cars where they're able to get a very significant write-off on that.
And a quick tip too is when, you know, the power of claiming the home office. Once you claim, you know, you have an office in your house that you're claiming a home office deduction for, when you leave your house to go do various real estate or business related miles, that's a better support and better case for those are business miles, because now you've left your quote unquote office, right? Your home office. Once you leave there to go do those various things, that's another great support for those business mile deductions.
Yeah, and just again, the higher your income tax rate, the more important it is for you to save on taxes. So if you're in the 50% federal and state tax bracket, $20,000 in expenses can save you $10,000 in taxes. So now the other question that we see a lot then is, you guys keep talking about business expenses, but I don't have a legal entity for my rental properties. Does it mean I'm not eligible to take these expenses? The good news is no, you don't need to have a legal entity to deduct your expenses, but there are times when an entity can give you additional benefits compared to no entity. So, for example, asset protection, right? If people were to sue, there's federal liability protection if you have an entity. But for the most part, a lot of those overhead expenses we just shared on the previous screen, you're able to deduct those against the rental income regardless of whether you hold your entity whether you hold your rental in an entity or not. Okay, so again, a common mistake we see, but you don't need to have an entity to take those write-offs. I think at the same token though, for those of you owning rental real estate, we do want to make sure that you're in the right type of entity because that could cost you a lot of money.
Yeah, I mean, when it comes to rental properties, now the answer to this question is not one size fits all. You definitely want to talk to your team of advisors, but just 30,000 foot level, we do like using LLCs to hold title to rental properties. Reason being is it's easy to get the property in and out of the LLC if you need to for financing purposes for whatever reason, and it doesn't create tax consequences when you move it back and forth. On the flip side of that, to Amanda's point, is what's the wrong type of entity for rental properties? Well, the wrong type of entity would be like an S corporation or a C corporation. We don't ever want to use the C corp or an S corp to hold title to our rental properties. The reason being is that when you move properties out of the C corp or an S corp, if you had to again, the lender wants you to, you want to refi the loan, but the lender says, well, the title's got to be in your personal name. Okay, well, you change title from S corp to personal, that actually creates a tax problem for you. So that's the reason we don't want to use S corps and C corps. It's such a common mistake people make out there that we've actually even seen colleagues with T-shirts that say no to the S corp or something like that, right? So it's something you got to keep an eye out for, because yeah, you have the wrong type of entity, it can come back to create tax issues for you.
Now let's talk about one of our favorite tax topics outside of retirement investing, which is the concept of income shifting. Income shifting is really just a fancy way to ask, how can I pay my kids and take a tax deduction for it? So the concept is to see if there are ways that your kids or maybe other family members who are in lower tax brackets than you, how can they help out in your real estate business and be able for that to be a tax benefit for you? So for example, can I hire my child to help with marketing or with tenant turnovers on my rental properties? And if so, and I pay them a reasonable compensation, then the money that I pay them to do the work would be tax deductible, just the same as if I paid anybody else who was unrelated to me. And so this is a really great strategy because let's face it, we all give money to our kids, especially with summer coming up. I would take a look to see what are some things that they can actually do to help out in your business. They can learn some really great life skills. You have some quality time together, and it could be a tax benefit too, right? Again, if you're someone in the 50% tax bracket, if you paid your child $5,000, that could be a $2,500 of tax savings on money that you are probably just going to give to them anyway.
Yeah, and that's what I love about this, right? Is that this is money. For those of us who have kids, we know where the kids are expensive. We're giving money to kids already, and I love the way you kind of put it earlier. Is like changing kind of the way we ask the question, because a lot of people, if you ask the question of, can I ask 100 CPAs, can I deduct the money I'm giving my kids? Most of the CPAs are going to say no. But change the way you're asking the question. It's better way to ask the question is, how can I take a tax deduction for money I'm giving my kids? And that's by getting them to help you in your business. I mean, my favorite thing about this slide is that, hey, this is cool. It looks like dad's teaching the kids something, but you know, I don't know, after COVID or what have you, this kid's probably showing his dad how to use, you know, go to webinar or like, you know, chat GBT for that matter nowadays, right? So,
Yes.
I was gonna say, Matt, Amanda, we actually on this topic, someone just had a good question that pops in. It says, how young is too young to pay a child? And then where on my tax filing do I put that expense? I guess that, you know, they maybe address that, like how, I know I've seen some people open up some Roth IRAs for their kids when they were 1 or 2 years old. So I'm assuming if you could help answer, lighten that question a little bit.
Yeah. That was going to be our next talking point too. So there's, from a tax perspective, there's not a minimum or a maximum age requirement. So we've seen people pay their kids from 1 year old to 25 years old. Right. The key though is that the compensation has to be reasonable for the tasks that they're doing. So someone who's very young, and the most that we see people do is maybe they'll be paid some small amount for like modeling and things like that. As they get older, you know, teens and above is when you can typically shift more income to them because their skill set is a lot more elevated. So that's what is required by the IRS, reasonable compensation. So the thing you look at is, if I was not paying my own child for this and I paid somebody else's child, what would be a reasonable compensation for that task? And again, we have it where, you know, they're paying their kids who are like 25 years old who's moved back home or something like that. And yes, the benefit, like what Scott was saying, is that once your child or other family member has earned income, now they can put that money into a retirement account. The most popular one of choice is Roth IRAs. Why? Well, because at their young age, they're probably already not paying taxes on that income. So why not put that money into a tax-free bucket like a Roth account that will grow tax-free over their lifetime, right? If they're 15 years old, I mean, there's so many years of tax-free compounding growth that could occur within that Roth account, especially if you use this year after year to fund it, right?
And then when you have the other part of the question is, where do you take the deduction? You take the deduction, you know, on the form or the schedule to which the business that is paying the kids relates to. So step back, if you have some people are real estate agents, so they might file a return on, you know, a 1099 income, you know, sole proprietorship on a Schedule C. Well, if you're paying them to help you in your real estate agent business, you take the deduction as, you know, wages or other services on your Schedule C. If they're helping you in your rental properties, then you would take the deduction on Schedule E, just if you were paying some other employee or some other contractor for that matter. So hopefully that helps.
Yep. And, you know, income shifting is not just limited to kids. It could be to other family members. We've seen a lot of, you know, semi-retired parents that people are shifting income to. But along those same lines, since we covered a bunch of tax deductions, we just wanted to share a funny slide. These are crazy, or what we consider crazy deductions, allowed by tax courts. So the stories behind each of these are where the IRS disallowed these write-offs. The taxpayer went to tax court, and the tax court sided with the taxpayer, who said these became allowable deductions based on the facts and circumstances of each case. So this is not to say that all of you can deduct your babysitting fees or breast augmentation, but in the right scenarios, they could be legitimate tax deductions. And I'll share one about the girlfriend. The girlfriend is actually a real estate case. It was a gentleman who gave money to his girlfriend, wrote it off. IRS said you can't write off money you give to your girlfriend, obviously. He was able to prove in tax court that the money he gave to his girlfriend was actually for her helping out on his business, on his real estate. So sounds very similar to income shifting, right? Like you said, income shifting is not limited to kids. You can use that for all types of other individuals within your network or, you know, sphere that is in lower tax bracket and can be working for you. We can't talk about real estate without talking about depreciation.
Yeah, depreciation is probably one of our favorite things, and from a tax planning perspective, I like to refer to it as the ninth wonder of the world. But when, you know, why do we love real estate, you know, maybe over some other asset classes from a tax perspective? So think about it, is when you buy real estate or you buy stocks, right? You pay $10,000 for a particular stock. You don't get to write off the cost of that stock right now. You don't actually get to write off the cost of that stock until you sell it down the road, right? That could be 2 years from now, 5 years, 10 years from now. But with rental real estate, when you buy rental real estate, the IRS actually allows you to take a depreciation deduction every year. We call it like a paper write-off for a portion of the purchase price of the building against the income that you're making from the property. So think about if you $10,000 of positive cash flow from a rental property, with that paper write-off from depreciation, you may not have to pay any taxes on the money on the cash flow that you earn this year. And that's what the goal of, and why we love investing in rental real estate. Now, residential properties generally depreciate over 27.5 years. If you're buying commercial properties, those are over 39 years. But there's ways to supercharge that with doing like a cost segregation study. There's ways to kind of say, hey, if we're going to implement a cost segregation study, go and look at this property. There's ways to take depreciation a lot faster than 27.5 years or 39 years for that matter. And this is all, I mentioned depreciation is all based on kind of the purchase price of the building. That's the starting point. And this is true regardless of how much down payment you put on a house. So let's go over an example. So let's say you had $100,000 to invest. There's a couple options, right? You could either buy $100,000 property all cash and you get, in our experience, probably $20,000 in depreciation maybe that first year. Or you can use $100,000 as a down payment, get a mortgage and buy a $500,000 property. And in that situation, your $100,000 of cash might generate you $125,000 of depreciation expense. So you can kind of see the power of using leverage, obviously, when you're buying rental real estate, because again, the depreciation calculation, the starting point is going to be the purchase price of the property. You're going to break it into building and land and go from there.
I really like that. Basically be able to use the bank's money to get more depreciation tax benefits for yourself. This is how people build wealth in turbo mode, really, right?
Yeah.
All right, so let's talk about, I know, we've seen more and more people getting in. Years ago was everybody just did long-term rentals, but I think in the past several years, we're seeing people get into long-term rentals versus short-term rentals like Airbnbs and things like that. Now there's also people getting into mid-term rentals. So one thing really important to keep in mind is for those people who are investing in long-term and mid-term rentals, if your income is higher income, that's typically defined as someone making over $150,000, if you generate a net loss on your rental properties, that loss can only offset W-2 and other income if you or a spouse is a real estate professional, okay? For everybody, regardless of how much money you make, we can always use rental losses and depreciation to offset taxes from the rental itself, which is what makes real estate investing such a great tool from a tax perspective. But there's that second layer where if you can use the loss to offset not just rental income, but also W-2 income, that's where you see a very significant tax difference of someone maybe going from 37% bracket down to 15 or 24% tax bracket. Real estate professional, contrary to popular belief, does not mean you have to be licensed as a realtor or broker. It comes down to the number of hours you spend on real estate. So at a high level, the 3 tests you have to meet to be a real estate professional is at least 750 hours in real estate. You have to spend more time in real estate than your job. So for those of you who are working full-time, that would be difficult, if not impossible, to try to meet that hour. But if you have someone who's a stay-at-home spouse or working part-time, then that might be easier. And then the third rule is you have to meet material participation. So if you meet material participation hours, those typically are defined as at least 500 hours on your long-term rentals. Then you get into that golden spot where you can use rental losses to offset W-2 and other income. So that rule applies to those of you investing in long-term and mid-term rentals. For those of you who are doing short-term rentals or interested in short-term rentals, there's a tax loophole in that you don't have to be a real estate professional. So we have a lot of clients who make high income investing in short-term rentals. As long as you meet material participation hours, those tax losses that you created strategically can offset all types of income, including W-2 and maybe retirement distribution too. So for short-term rentals, you just have to meet material participation hours.
Yeah, and that's probably why we have a lot of clients that have been investing in short-term rentals the last couple of years. Obviously, just economically, they were performing well as well. But from a tax perspective, if you are working full-time or you and your spouse are working full-time, it can be a lot easier to be able to use rental losses from short-term rentals to offset W-2 and other income than it might be to try and qualify as a real estate professional if you're both working full-time. Because again, if real estate professional for your long-term properties, you got to spend more time in real estate than your job. And again, if you're both working 2,000 hours, that's going to be a tough argument to make that you're spending 2,001 hours on real estate just from one of you, right? So
yeah, and if the terms real estate professional and the short-term rental loophole are sort of new to you, you can visit our website at keystonecpa.com. We have a really great tax savings toolkit where we dive into detail about this, because this topic alone could be like an 8-hour webinar. Maybe Scott will come back and talk about that in depth, but just wanted to make sure we kind of touch on it a little bit, because it is important for those of you who are investing in real estate outside of retirement accounts. So of course, like we said, we never talk about tax planning without addressing the tax benefits of retirement accounts. The way we look at it is, would you rather pay yourself, or would you rather pay the IRS? A lot of times that's really what it boils down to, right? I can either put money into a retirement account and reduce taxes, or I can just give it to the IRS.
People are sitting there thinking, wait, is this a trick question? Would I rather pay myself or give it to the IRS?
Yeah. So there's all the different types of retirement accounts, like Scott has said earlier. A lot of times, because our clients are mainly people who are investing in real estate, one of the limitations that they that they're concerned with is, if I tell someone, hey, you can put $50,000 or $100,000 into your retirement account and we'll save 50% taxes on that. Sometimes the response is, well, that's great, but I really wanted to keep that money and use it for real estate. And here's the benefit, though, is with self-directed investing, we can accomplish both, right? We can put money into retirement account, get a tax deduction immediately, and turn around and use that money for real estate and have it grow in a tax-deferred environment as well.
Yeah, that's the power of using retirement accounts to invest in real estate. And there is sometimes when you buy leverage real estate in your retirement account, as Scott was mentioning earlier, there may be a tax you have to pay. Now, some people, just touch on that for a second, the UDFI or the UBIT, whatever you want to call it. Some people shy away from using their retirement accounts to invest in real estate because they're scared of this UBIT or UDFI. It's like, well, I don't want to pay taxes in my IRA. We'll go back to the original question is, what is your retirement account investing in now, and how is it performing? So a lot of reasons our clients use their retirement accounts to invest in real estate is because they understand real estate. They feel like they know it better than obviously the stock market and mutual funds. So if you're gonna, invest in something, and you make 4% in a mutual fund, but you're gonna invest in leverage rental real estate, make 10% and pay, lose 3% of, down to 7% after-tax return. Well, you're still making more money after UDFI, right? So that's something to think about, is don't shy away from using a retirement account to invest in real estate just because it's of the UDFI concern.
Yeah, I mean, we have a client, Ron, who's in his early 40s. He does a lot of real estate investing, flipping mostly. And so one of the things we help him to do each year is to maximize his contributions to his solo 401k. The money that he puts in the solo 401k helps to reduce taxes from the flip income that he's making. So every year, if he contributes 40 to 50,000, he's getting a tax write-off saving close to 20 to 25,000 each year. And the best part, though, is the money that's in the retirement account, that's still his money, right? He didn't lose it to the government. And so what he can do is, save up over the years, and now he's buying an apartment building in Oklahoma. The projection is going to have really great cash flow from it. And the cash flow from the rental will then go back to the retirement account, which will be free from current federal and state taxes and capital gains taxes too, right? All that is going to be tax deferred until he takes it out at retirement account. So not only is he avoiding federal, state, and investment taxes now, but that money is also growing tax deferred, versus the alternative, which was not fund the retirement account, lose part of that to IRS, and get zero return on investment. So again, this is kind of what we typically look at when we look at retirement investing.
Yeah, and Matt, we did have, just somebody did have a question. We have a number of them that we'll get to in a minute. So people who are asked questions, we'll get to some of them. But yeah, somebody just asked, I'll answer quickly. With the real estate investments made from a self-directed IRA account, can I still take depreciation benefits? And covered at the very beginning, maybe that wasn't clear or we weren't on at that time, but you, generally speaking, cannot take depreciation benefits from real estate held inside of a self-directed IRA unless that property is mortgaged or encumbered with debt. In that case, if it is a leveraged investment, the IRA can take depreciation to help offset that UDFI or UBIT. But if it's an all cash investment that you have, depreciation is not available to you. So just want to make sure I answered that question. And again, we have plenty of others that have come in, and we'll get to those in a minute. But Amanda, Matt, yeah, continue on.
Yeah, that's a good question. All right, so we covered a lot of stuff. We wanted to kind of put a quick little summary together for what we call tax savings in action to kind of combine all the different strategies. This is taken from an actual client example. We just kind of rounded the numbers, changed the name. So this is a married couple making about $350,000. We have one spouse who's working full-time, the other spouse is a stay-at-home. So started investing in real estate, bought their first, I think it was 2 rental properties, generated about $32,000 of net rental income that first year. They did a little bit of income shifting to their kids. They have young kids, so nothing super crazy, but got about $2,000 tax deduction. Tracked their car and home office expenses. Again, nothing crazy, didn't buy a Tesla, just really tracked their business use of their car and home office, got about $10,000 of expenses. Depreciation, this was 2022 tax return. They did accelerated depreciation, got about $198,000 of depreciation that they're able to use to offset their total income because one of the spouses was a real estate professional. I think the total purchase price of the 2 properties is maybe about between $700,000 and $800,000. So this is the type of depreciation that they received. They also made some investment in passive syndications, got a $38,000 loss that they're able to use. So all in all, their income went from about $380,000 down to $133,000 for tax purposes. And that's a tax deduction or reduction of about $248,000.
So think about that for a second, right? So they're reducing their taxable income by almost $250,000. For them, that was close to about $100,000 in taxes saved. I mean, that's that example we gave earlier, right? Like that's a down payment on another $500,000 a piece of property, right? So to kind of save as much taxes now, stop the tax drag, you reinvest that money, continue to build wealth, continue to generate your passive income, whatever, help you guys reach your goals.
Yeah. The one thing we want to make sure that you take away from today's presentation, though, is that scenario we just described is not the same. Didn't happen by chance. So it was very intentional about what they were doing during the year to buy the right properties, to meet real estate professional status, and to do all the right things. So as we move ahead for the rest of this year, take the time to speak with your tax advisor and look for ways on how to save on taxes before implementing any of these strategies. I think our PowerPoint has stopped working. Let me try to open it up, but the last slide I was going to share was actually a QR code.
Okay, and it was again a couple of these questions were right on that same vein you were talking about. Someone asked, you mentioned the home office and setting up a home office. Someone asked, does that make you more likely to be audited though? I know I've seen articles written about that too, or maybe if it does, or what ways can you guard against that?
Yeah, I know it is it's actually probably one of the biggest misconceptions we see out there is that a lot of people still believe that or hear that or from whatever sources, right? That claiming home office subjects you to a higher rate of audit, and that's just not true. A couple of years ago, the IRS actually came out with a standard deduction for the home office because they realized how many people were working from home. I read an article a couple of years ago where and this is even before COVID, was 50% of Americans had a home-based business of some kind. So yeah, it was an audit flag 20 years ago when it probably came out, but it's not anymore. So our recommendation is if you have a dedicated space in your house that you're using as an office to run your real estate or run any business you have, don't be afraid to take the tax deduction for sure.
Okay, last question that was, I know, related to that slide. We'll move on to a couple others. Someone said, if I'm already deducting my vehicle rental cost, can I also still have mileage deductions, take mileage deductions for driven?
So yeah, when you're taking your auto expenses, there are 2 different ways you do it. You do it based on the standard mileage method, which is the number of miles times this rate per mile, or you take your actual expenses. Your actual expenses would include, if you're leasing the vehicle, include lease expense. It could include gas, it could, repairs, oil changes, car washes, other kind of stuff. So it's going to be one or the other, but in either scenario, just to kind of make it clear, is that you should still be tracking your mileage in either scenario, because even in the second scenario, we're using the actual method. You're only taking a business deduction for the percentage of the cost based on the business use percentage of the vehicle. So if you're only using 80% of the time for business, you're only writing up 80% of your actual expenses, but you're only going to know that based on keeping track of the mileage, business miles versus total miles.
Okay, thanks for answering. So the next couple of questions was about the income shifting. Obviously, probably the most common income shifting is bringing your kids on the payroll. And someone asked, does that create income tax liabilities then for the kids, or what? How do you have to be careful maybe so that you don't have that occur?
Yeah, for sure. And this is definitely where working with your advisor comes in handy, because we want to look at what are the other income that the kids are making. So this year, I think up to what, 12 or 13,000 that, that they make.
Yeah, it's about $13,000. Everybody has a standard deduction. So a child could theoretically make up that amount of the standard deduction and not have to pay any income taxes. So now obviously if they're working multiple jobs and making more than that, they're going to pay income taxes above that amount. But that's the key with income shifting, is for a lot of people, especially younger kids, you're not paying them $20,000, $30,000 a year, right? You're paying them.
Even for our clients who have older kids, and the kids have to pay some taxes, oftentimes it still makes sense to do it, because there are scenarios where the parents might be at 37% tax bracket, and the kids, if you pay them, good amount of money and they're paying taxes on even 10% of it, there's still a pretty significant savings across the board as a family, right? So you got to kind of look at the overall picture to see whether it makes sense.
Okay, another question related to income shifting, but maybe not to another individual. Someone asked about, what about shifting other income, I guess would be active business income, to passive, and making that income passive? If you were owner of another business, they could work less in order to shift that to passive and then be able to offset long-term rental losses. Is that correct? I guess is their question. Is that another way to do it?
Yeah, that's definitely a great strategy that we use with a lot of our clients. And it's because passive losses can offset passive income. So the question is, okay, well, let's look at all the different income sources you have, and are there any ones that are active that really should be considered passive, or are there strategies to make them passive? We were just looking at a tax return recently. It was a physician who invested in a couple medical related businesses. The old CPA has grouped them together to make them all active. But when we looked at it, I said, wow, that was really a poor decision, because the grouping could have easily been, done differently in the beginning, so that some of those investments that are kicking off great cash flow as considered passive, now all his rental losses can offset the taxes from those different investments. So yeah, definitely a great strategy that could be very powerful.
Okay, another question. I think you may have mentioned this, but I think we were talking about the long-term rental versus short-term rental, and there was the loophole, I guess, for how much you're working. Somebody asked, how many hours are needed for that short-term rental loophole?
So for the short-term rental, in order to use, if you're going to create rental losses in your short-term rentals and you want to use it to offset W-2 and other income, you need to meet one of the material participation tests. There are 7 different ways to do it, but for most 99% of the people out there, generally there's only 3 of them that really apply to most people. So one of them is that you are spending 500 hours a year on your short-term rental or short-term rentals, doing the right type of stuff. Kind of think of it like you're self-managing your own property. So you're getting tenants in there, you're staging it, you're buying the furniture, you're overseeing rehab, whatever it is, but you just have to have at least 500 hours of those type of hours. Now, if you can't get to 500, lower thresholds that you could use to meet would be, you spend at least 100 of those hours. You spend at least 100 hours doing that same stuff, and it's more time than any other single person spends on your property. So example, you have 120 hours and you look around and you say, hey, that contractor spent 115. That's the most that any single person spent on my property, so I'm good. Or if you can't get to 100 hours for some reason, the next tier down would be, you spend any amount of time on it, but it's more time than everybody else combined who spent time on your property. So I don't know, example would be you spend 90 hours and you look around, you add up all the time that people spend on your properties and it was 80 hours. then you've met the material participation standards and you could deduct your rental losses in that third example as well. You know, there's pros and cons to each, obviously, but those are just different ways you could do it.
Yeah, so one other question we didn't touch on, I don't know if you really touched on 1031s, and maybe we can, definitely the person asking this question, I have a contact at Dave Foster who could probably answer anything you need about 1031s, but someone asked about how can I reinvest, I'm selling an office building, and how can I reinvest using a 1031 exchange, but then reinvest in managed property like a REIT. So I'm not sure how familiar are you all with the 1031 rules. We can certainly, like I said, have them ask Dave Foster that question, but.
So 1031 exchange, typically the replacement property is going to be the actual property. REITs, also known as real estate investment trusts, those are typically set up as C corporations, and that's where the issue comes in, because you're selling real estate replacing with shares in a corporation, even though the corporation owns underlying real estate. That typically is not allowed. So same as like if I sold a rental and then I'm going to reinvest into a syndication where I own, 5% of an LLC in a large apartment building. That's where some of the limitations come in. But with proper planning, it is possible to reinvest your 1031 money into something like a syndication. What we typically see is there are syndications that set up as DSTs. And so, if you have either if the syndicator is already set up that way to take 1031 money, or if you have a significant amount that you're willing to invest into that deal, they sometimes will create separate DSTs just to accommodate your needs. So the starting place, I would say, is, look at the different sponsors for syndication and then find out from them whether they take 1031 money or how you can use 1031 money. Sometimes you'll find ones that are willing to work with you. I think that's probably as passive as it gets. That's similar to REITs, but if you're just looking at REITs specifically, that's not really possible to do because those are corporations and you're investing in a stock basically.
All right, well, Amanda, Matt, we're pretty much out of time at this point. I know there were just a couple other questions maybe we didn't get to. So anyone who asked a question, I apologize, we just didn't have the time to get to everybody's question. You can certainly, again, download right here at the QR code on the screen, or just go to keystonecpa.com, reach out to Matt and Amanda, whether it was following up on a question that you asked or maybe one that you just didn't get around to or something else that comes up later. Obviously, reach out to them and get those questions answered. But Matt and Amanda, I really appreciate your time in joining us today. And we probably would love to have you guys back again in a few months when go over some other maybe year-end tax tips or things like that as well. So any parting thoughts you had for our audience?
Yeah, definitely. Year-end is one of the best opportunities to kind of play catch up on tax planning. So we'd love to come back and talk about that. A lot of really great retirement-related strategies there as well. And yeah, definitely for anyone who we didn't get to your questions, you can visit our website at keystonecpa.com and schedule a free consultation with our team.
All right, well, thank you very much. Again, thanks everyone who attended. If you're listening live, they appreciate you being on and asking the questions as we went along. Obviously, we recorded this webinar, so anyone who's listening to the recorded version, definitely reach out to Matt, Amanda, or myself if you have a question on self-directed IRAs. So Matt, Amanda, thank you again for your time, and we'll look forward to having you back.
Yeah, thanks again, Scott. I appreciate it.
All right, everyone, have a great day.